Hey, in this video, we're going to talk about how to avoid taxes legally as a real estate investor when it comes to selling property or just owning real estate in general. All right, let's get started. Okay, so how do you avoid taxes legally? I mean, that's what we're talking about, right? We're not talking about any underhanded, shady stuff, because if we were, well, we'd have to turn the lights down and you would have to pay me for that type of information. Just joking. So here's what I want you to know. So the first strategy we want to look at, if you want to avoid taxes or minimize your taxes on your real estate, the best strategy we're using right now is going to be cost segregation, all right? That is an awesome tool right now because it allows you to accelerate your depreciation on your property. You couple that with bonus depreciation, you can oftentimes get a deduction for approximately 25, 30, 40% of the property's value. So if you bought a property and it's worth $400,000, you could be looking at a tax deduction of nearly $150,000 on that property when you use cost segregation with bonus depreciation. Now, there are other strategies as well we're going to talk about. The next big one that I see people make or like to do is called a 1031 exchange. Now, you're probably sitting here going, well, I already know about that one, Clint, where you can sell real estate, and as long as you roll all of the proceeds from the sale of that real estate into replacement property, you won't have to pay any tax on that transaction. Okay, so those are two easy ones, and I have other videos that talk about it. But here's something else you might want to consider. If you're looking to avoid paying taxes on real estate, you're looking for deductions, then consider donating your property, donate your house to a charitable, I'm just going to put CRT, which is a charitable remainder trust. Now, this is a great strategy for people who don't want to lose their property, don't want to lose the income that's coming in from that real estate, but wants the IRS to give them a tax deduction. It's a great tool. If you have assets that have appreciated, your real estate you put money into, essentially what you do is you set up a trust and you take your property and you deed it into the trust. And if that property, let's say this property is valued at $600,000, you're going to get a tax deduction for roughly $60,000 or more just by transferring that real estate into the trust. And when you do that, the other benefit that comes is that once the property is held in the name of this trust, all of the income that comes in from that property is completely tax-free. You do not have to pay any tax on that income that's generated inside of that trust. Now, what does that mean? How about if you want to take the money out? Well, when you decide to take the money out, then you'll pay tax on that income when you start pulling it out. So it's a great strategy for those individual investors who need a tax deduction this year and they don't want to pay tax on the rental income going forwards until they're ready to absorb it. So if you look at your tax bracket and you think, hey, in 5 years, I'm going to be a lower tax bracket. That's when I want to receive my rental income. Consider using a charitable remainder trust. Other ways to reduce taxes on your real estate. Use the de minimis $2,500 deduction. De minimis $2,500 deduction. Now say, so what is this? So when you're looking at real estate, there's two, and you're going to spend money on that property, you always have to ask yourself, is it a repair or is it an improvement? Well, if you're not aware of this, improvements cannot be deducted in the year in which you've incurred the, I'm going to call it expense, well, the improvement. So it's going to have to be depreciated. Now, obviously, if I have a piece of real estate and I have some repairs that need to take place, those are currently deductible, so I want to make sure that anything that I'm spending on behalf of the property isn't looked at as an improvement by my CPA, which means it betters the property, increases its useful life, such as replacing a roof or replacing the framing in the property or something like that. If you can show that it's a repair because something was broken, maybe you had to repaint a wall or the trim it was destroyed by your tenants, well, then you can immediately deduct that in the year in which you incur the expense. But here's the benefit of the de minimis deduction. If the amount, the invoice for whatever you're doing is $2,500 or less, you don't have to determine whether or not the money you spent is considered an improvement or repair. It's automatically a deduction to you. So here's the example. Let's say you go into Home Depot and you're going to replace your appliances in the house. Well, if you go in there and you buy 5 or 4 appliances in that and it amounts to $8,000, well, you're not going to be able to deduct that. It's going to be treated as an improvement because you're bettering the assets inside of that property. But if you went into Home Depot on 4 separate occasions and you bought separate appliances and each individual invoice was less than $2,500, well, now that's a repair and it becomes a deduction to you. So you get what I'm saying now. You bring out a plumber and you know you got to do a lot of work here because the line's busted from your house out to the main. What do you say? Give me a bid just to fix this portion right here and try to keep it under $2,500. Does the work, then bring it back out. Hey, can I get a second bid? Because I think I want to replace this section right here. And so then you do another one, another $2,500 deduction. So with real estate, there's many ways in which you can deduct your expenses against your income if you're using the de minimis $2,500 deduction. Now, another thing you can look at is buying real estate in a self-directed IRA or solo 401k. All right, so there's another strategy there. If you buy property inside of a self-directed IRA, then the income generated from that property is not going to be taxable to you. If it's a Roth IRA, it'll never be taxable to you because in a traditional IRA, when you pull the money out in the future when you retire, yes, that is taxable. But currently, it's tax-free income until you pull it out, unless, of course, it's a Roth and it's tax-free forever. So this is a strategy that a lot of real estate investors use to avoid paying taxes legally on their real estate income. Another thing you can look at is borrowing against your equity. All right. Now, so why would I say this? Why would you want to borrow against your equity? Because when you borrow against the equity in your property, what you're doing is you're pulling out that amount that the lender's willing to give you, say it's $300,000, out of the increase in value. Because it's written up as a loan, it's not considered income to you because you are obligated to pay it back. So this is how real estate investors are able to take advantage of the appreciation in their real estate without selling it, get access to that cash so they can go out and buy more property because they borrow against the equity in the property and it's not considered to be taxable to them. Another strategy there, the last one I want to talk about is donate your property to a conservation easement. I'm running out of room here. Donate your property to a conservation easement. This is a phenomenal strategy right here. So let's assume that you buy a piece of property. I've got some room here. So I got this house and it sits on 15 acres. Well, when I tell you to donate your land to a conservation easement, make it a conservation easement, you might be thinking that you have to move out of it. Well, in fact, you don't have to move out of it. What you have to do is just get this land appraised. And what you're going to say is, listen, I'm going to make sure this property will never be developed. It will stay as is. You still own it. But the fact you're agreeing to keep this in its natural state, you can get a tax deduction for that. Many times, you buy 15 acres, you have a house on it. Do you intend to develop it? Some people say yes. Most people say no. I'm never going to do it. So why not just take that property, turn it into a conservation easement, pick up a federal tax deduction by doing so, and use that to offset your income. I've seen this done a lot of times by individuals who buy large pieces of real estate, but it also works for smaller tracts of land as well. The key is you just want to show its best use, get a valuation for that property, then apply for your easement deduction. Hey guys, I gave you lots of different ways to avoid paying taxes on your real estate. Go through there, maybe 2, 3, 5 of them work for you. Take advantage of them all. That's what the tax code is for, is so that it can ensure that by investing in real estate, you're generating some of the best tax deductions that are out there. If you liked the video, hit the like button and be sure to subscribe to the channel if you're not already a subscriber.